So on the screen here is something really fascinating. It shows you the amount of bulls compared to the amount of bears in the stock market at any given point in time. Currently, according to Investors Intelligence, there are 4.43 bulls to every bear in the stock market. This actually is above 2021 levels, which is crazy to think about. According to AAII, another firm that does similar research, the bull-to-bear ratio is 2.23, much more subdued, but as a whole, their numbers are always more subdued. Still, taking this year's data compared to 2021's data, we're at least in line with the amount of bullishness there was at the peak of the markets in 2021. The markets are particularly susceptible to any bad news when we have this amount of bullishness in the stock market. And what do you know? Today we got that first bit of quote-unquote bad news. You'll see with the NASDAQ, with about 2 hours left in the trading day, the markets decided to tank. And this was for a reason. We had Federal Governor Kashkari, Neil Kashkari, say 2024 rate cuts are under threat if inflation continues to stall. His exact quote was, "If we continue to see inflation moving sideways, then that would make me question whether we need to do these rate cuts at all." There's a lot of momentum in the economy right now. And I actually agree with him. If you haven't watched my most recent macroeconomy or broad-based stock market video, click the eye in the top right-hand corner and go watch that. In that video, I laid out two different scenarios. One, the Fed cuts rates 3 times this year, disregarding the fact that asset prices and commodity prices are all at basically record highs right now. And we enter this extreme melt-up phase short term. And then long term, we have a very painful contraction when the asset bubble pops and the melt-up melts down. The other scenario is the Fed wakes up to this fact and realizes they don't have to cut rates. And in fact, they shouldn't cut rates because they're winning the battle against inflation. Why would you change your entire playbook if your playbook has been winning the game for you? That's what the Fed is threatening to do. But this is something that I've identified. If the Federal Reserve does flip and say, okay, maybe we won't cut rates, we're in for some short-term pain in the stock market. Not just because of how hot we've been since October 27th of 2023, but because the rhetoric in the stock market would quickly turn from how many rate cuts are we going to get, which is very bullish activity. It makes people want to buy stocks. That would quickly flip to, are we going to get rate cuts at all this year? And that's a big switch. And as a result, it's a bearish switch if it happens because investors up to this point have been pricing in rate cuts. If that changes, they have to deprice those rate cuts and the markets will fall as a result. To be clear, if this scenario plays out, we're going to feel some very healthy short-term pain in the stock market, but we're going to have a lot of long-term gain. But really quickly, if you are new here or returning and not yet subscribed, please subscribe down below. We're one of the fastest growing stock market YouTube channels on the platform. Thanks to you guys. I'm extremely blessed. This is an amazing community and it continues to grow. And I'm so thankful for it. I also want to give a quick shout out to Del Branch, Spin Second Serve, and James Harold. I didn't even know what super thanks were, but they've been giving me some super thanks comments and I greatly appreciate those donations as well. But with that, let's go ahead and get back into this video. Now, if you ask Tom Lee the question about interest rates, this is what he has to say.
Well, I think that the reason the idea of cuts was being rolled back was the January and February inflation reports globally showed inflation was accelerating. And part of that is a statistical aberration. There's just some really poor seasonal adjustments that take place. The March CPI reports coming out of Europe have shown a big collapse from those January, February levels. Like Eurozone, it's back to 2.4%. The March CPI for the US is coming out next week, which is April 10th. And by the time the Fed meets in June, there's going to be a total of 3 inflation reports, March, April, May. I think by then, markets are going to be a lot more confident that inflation is falling. And the 3 cuts actually may be too low. There's a possibility there's more than 3 cuts this year.
To be honest with you, much of what he said is true. There are seasonality factors at play here. But what I don't agree with him on is the fact we need, or we will see, more than 3 rate cuts this year. In the past, Tom Lee has been very accurate because he has been forward-looking with inflation, saying that as a result of these factors, inflation is going to come down long-term. he ended up being right. And I agreed with him at the time. I think me and him were the only two bulls in the stock market at the end of 2022. At least it felt that way. But Tom Lee needs to be very careful here. Again, this is another example of he can't change the playbook that's worked for him. Just because we've succeeded and we got what we expected when nobody else expected it doesn't mean we can stop looking at forward indicators when it comes to inflation. Right now, it is a fact that Bitcoin, the stock market, real estate, land, housing, gold, silver, oil, you name it, the asset, the commodity, whatever it is sitting close to an all-time high right now, more than likely. If the Fed comes in and they cut rates, what does that do? Well, it automatically creates an asset bubble because asset prices are already at all-time highs. If you increase liquidity and you loosen financial conditions, that's even more money that's going to be going into buying assets. And what does asset inflation lead to? Well, as a result of the wealth effect and people feeling more wealthy, they spend more money, which leads to more price inflation, which if we see a resurgence of price inflation, we're probably talking about double-digit percentages on the federal funds rate, which would not be fun. The fact of the matter is, with the federal funds rate at 5%, that is just a normalized rate. We're not necessarily high with the federal funds rate right now. We've seen that. It has not knocked down the economy that much. All it's done is knock the excess off of the economy that we got as a result of coming out of the great virus crisis. But especially with oil, this really worries me because oil is going to go up if geopolitical tensions increase, and oil will also go up if the global economy starts to bounce back. You know what? The price of oil feeds into everything in the economy. People, person, business, community, whatever it is, people pay for transportation, whether that's for product or to transport themselves to another location. If the price of oil goes up and the price of gasoline goes up and the price of diesel goes up, that always leads to increased inflation in the economy. The fact of the matter is right now, if we are forward looking with the inflation indicators we have, it looks likely that we're going to see a resurgence of inflation if the Fed does cut rates. And even if the Fed doesn't cut rates, we're still teetering on this very difficult to navigate balance between whether or not inflation is going to pick back up naturally or not. In my personal opinion, if the Fed comes in and they cut rates 3 times this year and the first time takes place in June or July, we're in trouble. And it's actually quite funny. In the bear market, when I was buying stocks and talking about how I was buying stocks and how I'm bullish on the stock market, people would call me a permabull. This guy's just a permabull. He doesn't know what he's talking about. Don't listen to him. He's not going to be correct. Well, the opposite is happening now. People are calling me a permabear. This guy doesn't know what he's talking about. We're in a bull market right now. He's going to be wrong. And I very well could be wrong, but it is just very interesting how normally if you are contrarian to what most people believe, you are going to end up being correct more times than not. Before today, I was actually favoring the likelihood that we would enter a huge melt-up phase in the stock market. But the more I look at this, I think we're trending for the better path. And this could change day by day. I might favor one or the other depending on the day. It just kind of depends how things shape out. But even Jerome Powell has awoken to this fact. He says, on inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%. So he too is saying if inflation stays bumpy, we're not going to cut. And honestly, that might be painful for some of you to hear, but it gives me great comfort in knowing that we're not going to see a melt up and we're going to avoid the meltdown or the asset bubble popping and economic catastrophe occurring. Now, on these headlines that the Fed is becoming slightly more hawkish, you actually had Treasury yields drop, which normally would indicate that the markets believe interest rates long-term will be lower than they previously thought they would be. But if we peel back the first layer of the onion here and think a little bit deeper, the Fed coming out and being more hawkish is actually better for interest rates long term because you remove the possibility that the Fed might have to re-raise rates and likely to double-digit percentages if the Fed is more hawkish currently, because there's a greater chance we would avoid a second bout of inflation if the Fed remains more hawkish short term. So actually long term, The markets believe interest rates will come down, but because we're going to be healthier from an inflation standpoint. Now, I want to make it clear, this is just my own theory. I'm not saying I'm going to be right or I am right, but to me this makes sense that the markets, because they see the Fed getting more hawkish, believe that inflation, at least they're more confident that inflation long-term is going to be lower. Now, back to the prospects of oil really quickly. The reason that I think we're in for a bounce with oil and energy stocks, especially, and why I'm concerned about this causing inflation is not just because of the geopolitical risks, but because the global economy seems to be waking back up. We can look at the price of copper, for example, and it looks like traders are betting on the resurgence of China's economy. And it's a fact, the data that we've been getting out of China has signaled that their economy has bottomed and they are starting to recover. If that happens, it's just another positive catalyst impacting the price of oil. So honestly, I do think at this point the markets are going to be in for some pain. Now, if this is the case, and this is the scenario that plays out, that the Fed is more hawkish short term to ensure we don't see a second bout of inflation, this is just going to present a tremendous buying opportunity. Another tremendous buying opportunity, which I cannot get enough of personally. If we look at the chart of the NASDAQ since October of 2022, so in 14 or 15 months, the NASDAQ is up 67%. We are just naturally due for a cool-off. And if we go back to October of just last year, a few months ago, the NASDAQ is up 26%. You never ever go up in a straight parabolic line in the stock market. And if you do, it's very unhealthy, and it's the melt-up scenario that I've been talking about. So is it possible we could see a 10 to 20% correction in the stock market? I think so. I think it would be warranted right now, but again, it's just another buying opportunity. There's always noise when you're an investor, but if you can ignore the noise and continue to make good investing decisions, good business decisions, buying undervalued companies when nobody else wants them, and selling them when they become overvalued, you're going to do just fine. So although this may have been more of a bearish video, it actually gives me more confidence in the longevity of this bull market. If we see a sell-off short term, which I think we're going to get. I think it's already started. The markets have been flat or red for the last month and 2 weeks or so. I think it's going to continue, and I think, it's just evident that a lot of good news is priced in right now. And again, that's when markets are particularly susceptible to bad news. We looked at the bullish sentiment of the markets right now. There are a lot of bulls and not many bears. So it's a lot easier to flip bulls from the bullish camp to the bearish camp than it is to flip the remaining bears from the bearish camp to the bullish camp. But with that, I know this video is a little bit shorter. I hope this gives you some clarification. I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.